Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 165. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
So before we get going, bit of housekeeping. We have delayed what should have been the Discord chat with Rogue Trader, which was meant to have happened on Wednesday night. But of course, it was the football, which we won. Final on Sunday, fingers crossed. Now, there will be no PM next week because I will be hiking in the Lofoten Islands in Norway, which I'm very much looking forward to. And I'm afraid we are now entering the summer holiday season, so it will be disrupted, our schedule. But when I'm around, I'll try and get something in. Now, news this week. Well, UK GDP numbers for May came out and they were surprisingly strong at plus 0.4% month on month. Looks like the UK economy is surprisingly resilient. We'll take you through the numbers. We had US inflation numbers for June yesterday and they were soft. Treasuries rallied. Disinflation in the US continues. We also had last Sunday the second round of elections in France, and that is a mess. So no party gained overall control. France is going to be hard to govern. Macron has left the country, I think, on holiday, on business, and is waiting for the rest of the parties to try and work out some sort of alliance to allow France to be governed. Let's wait and see what happens. Bank of England Governor Hugh Pill warned that inflation in the UK is persistent and markets have rode back on the likelihood that Bank of England first cuts in August. Separately, Jerome Powell has said the US economy is becoming more balanced with unemployment rising, and the market has become more confident of a September rate cut. So after the soft inflation data yesterday, markets are pricing in a 90% chance of a rate cut in September. And Joe Biden is desperately clinging on to the presidential candidacy in the US. He was interviewed last night. He referred to Vice President Trump instead of Vice President Kamala Harris. So some charts relating to the news. This is France and need 289 for a majority and nobody is close. So we don't know how France will be governed, basically. Wait and see. And the problem facing France, as we've discussed many times, is its debt to GDP is way, way above the Eurozone's 60% limit. And the socialists, who have the highest proportion of seats in the National Assembly, are committed to actually raising the deficit. So, big problems. Now, in the UK, sterling had a good week. And when you look at the history of sterling versus the euro or the US dollar, you'll see that it is well down on where it was pre-Brexit. Now, if Labour negotiate a more constructive agreement with the EU, then the pound should rally further. Turning to the US, well, inflation in the US for June came in soft, and these are projections for the interest rates at the end of the year, and you'll see investors becoming more optimistic about the path of US interest rates. This is the probability of rate the interest rate at different periods according backed out of the futures curve, and you'll see that the September, there's an 86% chance that the Fed will have cut rates. They're not pricing in a cut at the end of this month. And then by next year, markets are expecting a mean of around 4%. So 5 cuts by June next year. And the market is increasingly confident the US will cut. Not so confident the EU will cut. We'll take you through the data. EU wage inflation is persistent. And reminder, all these forecasts, they're always wrong. On to this week's economic data. First of all, summary. Well, the latest UK data shows actually the UK economy is resilient, but not growing strongly. EU is stagnant, lots of political uncertainty there, and the economy seems to be weakening on that uncertainty. In the US, the economy is strong, but there's some signs that the rate of growth is slowing, particularly in the jobs market. China, very difficult to tell. On to the UK, Richard.
Thank you, Keith. So this is UK GDP, which, as Keith just said, was better than expected, significantly better than expected. And it's sort of, I mean, if it can sustain a 0.4% annual monthly rate, then that's good. Maybe this is why Rishi Sunak called the election, and he just called it for a month later.
Well, this is, when you look at the 5 months of 2024, those are good numbers.
Yeah. And there is a bit of a trend, isn't there, from last July to this July?
Yeah. So, second half of last year, weak. First half of this year, that's 1.4% in the first 5 months of the year. I mean, annualized, if this can be sustained, you're talking about 3% growth, which would be, best part of, which would be amazing. Now, reminder, the IMF forecasting UK GDP growth for 2024 of 0.7%. And we've already had 1.4. So either they're going to have to revise their numbers up, or they expect the UK economy to weaken in the second half.
It's a finger in the eye to the IMF, isn't it?
Yeah. No, I agree.
And this is UK GDP growth year on year. But what we're really interested, I think, is over what's going to happen over the next few months.
Yeah.
Contributions to the monthly GDP growth in the year to May 2024. Services by far and away the largest, followed by construction, which is actually still quite strong, and maybe production though was I mean this is quite cyclical, isn't it? Quite variable, but there we are. Quite interesting that services is clearly the main contributor.
Yeah, construction has been resilient. It bounced back in May. It looked like it was softening, but bounced back.
And this is UK industrial production month on month, which is at expectation 0.2%. A small rate of growth, low rate of growth there. And industrial production year on year 0.4%, and revised down in April as well. Yeah,
it's not great.
No. So, and manufacturing production month on month, 0.4%, which is a quite a big rise actually over April's, but April's was particularly low. These numbers bounce around quite a lot.
Yeah.
Manufacturing production year on year was significantly revised down, and very significantly revised down actually. And year on year in May 0.6%. But as we know, really the main contributor to our GDP growth is the services sector.
Yeah.
And this is UK construction output year on year, which was actually revised up, although negative in April, 0.8% in May. So has construction probably, I mean, it's difficult on that chart because the scale is distorted by COVID, but it looks like construction has possibly bottomed. UK balance of trade. This is one of the big issues that this government's going to have to get to grips with, isn't it? Along with government borrowings, balance of trade not good, and it can't be balance of trade not good.
Yeah, it's been like this for decades, though. We're not paying our way in the world.
No, and we need to start.
Yeah,
frankly. We need to try and get it at least to neutral. I mean, every country should aim for a neutral balance of trade, shouldn't they? Because that means the world is in balance. UK BRC retail monitor, so retail sales down a little bit in June, but has that's showing a sort of not very nice last quarter in retail sales, isn't it? That chart. So the RICS house price monitor is showing that house prices are continuing to fall.
Yeah, but the thing is, we know that different measures of house price inflation in the UK have it positive. So I'm not sure what this is really telling us. Certainly more chances of surveyors are seeing house prices falling than rising. But then it's never gone positive. But we know that house prices have actually risen last year.
Yeah. The economic surprise index is as noisy as ever.
Yeah, but strongly positive, actually, and it's been right.
You may be right, Keith. UK job postings, is it flattening out? Is that decline finally flattening out?
Yeah, it does look like that, doesn't it?
Mm.
Actually rose on the last week. I mean, 1 week stays nothing, but
Yeah. And average wage growth is at 7%. I mean, this is what the Mr. Pill said, isn't it? Bank of England governor, that wage growth is high in the UK, and that's one of the big inflationary pressures we've got.
Yeah, no, this is an absolutely terrible number.
But it's still behind. It's still behind the degree of inflation that we've had over the last couple of years. So wage growth is sort of playing catch up with cost inflation.
But inflation's coming down. This needs to come down for inflation to settle down. And until it does, Bank of England is going to keep rates high.
Yeah.
Now, I still think that wage inflation should come down sharply towards the end of the year. But, right now it's not working.
So Britain's economy is very London-centric. And it's a slightly sort of spurious analysis, isn't it? Because if you took any capital city out of any country, you'd find that the GDP of that country and the economic potential of that country was severely damaged, surely.
Well, that's the red line comparison of the red lines, Richard. So the red lines are if you removed the richest region, what the average would be. And when you look at this, the UK just has a lot of regional inequality. And, the Northeast, in fact, a large chunk of the country is poorer than Mississippi.
Yeah, that's true.
Not good.
No, what we need is a levelling up minister.
I thought we'd had one. I thought we've had several of those.
Levelling up has been banned, hasn't it? The term levelling up has been banned by Labour. I mean, I don't blame them. I think it's a busted flush. But
well, the socialists are very good at levelling down, Richard. That's the alternative.
I just remind our viewers that we are apolitical.
Yeah.
So anyway, read the summary. Bottom line, UK economy is actually proving itself to be quite resilient at the moment. So fingers crossed.
Yeah. On to the EU. Thank you, Richard. So not much data this week. We had retail sales, which were weak in May, very volatile depending on the weather, but EU consumers don't appear strong. Year on year, growth of 0.3%, weak, but the April number was revised up quite strongly. Citigroup Economic Surprise Index, very poor. Sharp drops in EU economic data following the snap French election. Now, indeed, job postings again, like the UK, bit of flattening. Wage growth, though, not good. Like the UK, ticking up. A very different chart to the US. We'll show you the US in a bit. France stabilized a bit after that sharp drop following the snap elections. And unlike Germany, French wage growth showing sharp drops. These are advertised job postings. This is German industrial orders, and that is not a happy looking chart. Those are new lows, and it doesn't look like there's any recovery in the European manufacturing sector.
It really looks like to be not for six, doesn't it, Keith?
It does, yeah. This looks structural to me.
So I remember Peter Zion, who I don't think you have a great deal of respect for, said that Germany as a manufacturing economy was completely screwed by what happened in Russia and with the pipeline, with the gas price and so forth, Ukraine, and that it would not recover.
Well, it seems to be right. I mean, the Germans have rather shot themselves in the foot with their energy policy.
Yeah.
Becoming increasingly dependent on fossil fuels, even when they, they've got a very strong green movement.
Yeah.
Now, these are indeed job postings, European wages. And that is a really bad looking chart.
Netherlands, is that the Netherlands at the top, or is it Italy? It's Netherlands.
That is the Netherlands. Now, this is really odd, actually. Because, and I'll put this in the edit, Richard, because Dutch wage growth has actually been falling. So what's going on? Why are posted wages rising when actual wage growth in the Netherlands has been falling?
Yeah.
Suggests there's some strong sectorial effects or something.
Yeah. Basically, apart from France, they are all now moving upwards.
Yes, absolutely. Industrial production, that looks weak in France, Germany, and Italy. European manufacturing, not good. So very little data this week, but wage growth in the EU remains a concern. The economy appears stagnant. France remains in political crisis. Let's see what happens. US, Richard.
Thank you, Keith. So US CPI month on month still negative by 0.1% in June. Year on year, it's at 3%, and fairly steady at that level actually at the moment. So US core CPI month on month, 0.1%, and so there's a very, very clear, obvious trend over the last few months there. And core CPI year on year showing the same very clear, steady downward trend. And this is showing all the US inflation measures, trim, mean, median, and sticky price, all showing a clear downward trend. Goods remain in deflation, and we've had service inflation cooling sharply.
Yeah, great news in the US.
Yeah, all the signs are that US inflation is going to continue to fall. But the Fed is still very reluctant to reduce rates, isn't it?
Yeah, well, it's been burned last time because inflation, was resurgent.
Yeah.
So it doesn't want to make the same mistake.
Yeah, CPI inflation, ex food and energy, is very. The 1 month average is just about, well, there you go, very, very low. Everything is falling. So we've got strong disinflation at the moment.
Yeah, more recent data confirms that, the disinflationary trend.
Yeah. Shelter inflation fell in June. As we know, it's a lagging indicator, or it lags. Its inclusion in the data is basically lagged. So that is another contributor to reducing inflation. And service inflation is quite high, 4.5%, 5%.
But it is slowing.
Yeah.
but that's still not a good number. And, you're talking about the Fed being slow to cut. Well, this is why, really.
Yeah. And restaurant inflation started to rise again. So that's 4%.
Hmm.
And food at home really is, inflation on that is actually very low now, but in restaurant inflation going back up.
Yeah.
Probably mean, well, either maybe they're trying to catch up with the lost profits that they would have incurred during the very inflationary period.
Mm.
Car, this is why it can cycle, isn't it? Inflation, it can go.
Yeah.
It doesn't just come down, boom, because people have lost out during the first round of inflation, so they don't have to raise their prices to try and catch up during the second, and that creates a second round and so forth, subsequent round. So car insurance is the most inflationary category here, and airline fares are the most deflationary category.
Yeah. I find this odd though, Richard. Because over the course of June, Brent rose, so oil prices rose. So how come gasoline prices fell 3.8%? There's some lags in the data. I don't know.
Yeah.
Odd.
US non-farm payrolls revised down significantly in May, as they always are, actually, aren't they?
Yeah.
And June 200. I mean, basically, it's pretty stable, isn't it?
Yeah. Once again, it beat.
Yeah. US government payrolls. I would actually sort of rather discount April and May's data and just say it's fairly standard. A gain of 70,000, which is a lot, given the mess the US government finances are in. And healthcare and government have been responsible for most job creation, followed by hospitality and construction.
Yeah, I'm amazed by construction. It's really, given we know that the construction activity is finally slowing, but over the course of the last year, you've had over 200,000 net jobs.
Yeah, and we've got full-time employment continuing to fall, part-time employment rising, and full-time jobs, which is the blue line, down 1.6 million over the last year, while part-time jobs up 1.8 million.
Yeah.
It's not particularly healthy for the US jobs market.
Yeah, this of course is from the Labour Force survey. So the establishment survey is the non-farm payrolls. The Labour Force survey, paints a very different picture of the labour market.
Yeah. And the truth is somewhere in between, probably. So this is showing the largest number of full-time job losses the US has had without going into a recession over the past 60 years.
Yeah, amazing. When you look at other recessions, the recession starts when you start to get a downturn.
Yeah, so
but this time, no dice.
Yeah. And if you follow previous data, then this fall in temporary help services should have augured a recession, and it hasn't.
Yeah, absolutely.
And this is showing that non-farm payrolls have been revised down for the last 5 months, which makes you wonder why they don't just put in a fudge factor to reduce it by 20% in the first place.
Yeah, I think we know, Richard. They like announcing nice numbers.
Yeah, and then the revisions disappear into the mists of time.
Exactly.
With the financial market algorithms, have got the memory of a mayfly. And this is as the point Keith made, the household survey and establishment survey for jobs market actually show quite different things happening at the moment. I mean, the household survey is very noisy, and the establishment survey isn't. That's one. So the household survey sort of oscillates around the establishment survey, but now it's lost that. It has lost that linkage. It's not oscillating around it. It's oscillating it in a different place below it.
Yeah, odd. Very odd.
Yeah. Small business hiring plans still quite strong, but falling quite sharply. Another harbinger of a recession in the past.
Yeah.
And average hourly earnings month on month rose 0.3%. which is fairly chunky annualized rate, isn't it?
That's decent.
And this chart shows wage growth, median monthly growth in average hourly earnings by different sectors, and they're all falling except goods producing industries, which isn't falling.
Yeah, which is odd because we know that's the growth, manufacturing growth has been very poor, whereas service growth has been actually okay, but service sector wage growth is softening.
Mm. Average hourly earnings year on year, 3.9% growth. It's just a sort of gentle decline there.
Yep.
And US average hours worked per week has stabilized actually around about 34.4-ish, looks, doesn't it? Which is actually sort of back to the pre-COVID level, bottom end of the pre-COVID level.
Yeah, that's a weak number, but it rarely goes below that.
Yeah, I have to keep an eye on that. And aggregate earnings, which is hourly earnings times hours worked, is falling quite sharply.
Yeah, this is great news for inflation, actually. It implies nominal GDP growth is falling.
And it's the opposite of what's happening in Europe.
Yeah.
Real GDP is likely to slow. So real GDP sort of follows aggregate real earnings, which is potentially turning down. And if that continues, you'd expect real GDP to follow. In fact, actually, yeah, that's right. It lags by what, 2 or 3 months, doesn't it? 3 months, perhaps. Maybe more, maybe 6 months. US unemployment rate, 4%.
So 4.1%, Richard.
Yeah, yeah. And sorry, I was like sort of rounding down.
Yeah.
4.1%. But there is a bit of a trend there, isn't there? Just a gentle, shallow upward curve.
Yeah.
Labour force entry is boosting unemployment, which means that the rise in unemployment is not a product of people losing their jobs or unable to find a job, which means that the SARM rule, which is a recession predictor, may not work.
Yes, because recessions occur when people who are in work and currently spending lose their jobs and stop spending. And if they're not losing their jobs and stopping spending, then you don't get a recessionary cycle.
So this is showing that the US unemployment rate has risen by 0.7% from its cyclical lows, which happens after the start of a recession. So what we're sort of saying here is there's quite a lot of jobs market data of different types, which suggests that historically that the US should by now be in a recession, and it's not.
Yeah.
Then therefore suggests that something has changed in the employment market such that these indicators are no longer valid. One of which may be the large amount of immigration that the US has seen across the southern border during the Biden presidency.
Yeah. Or there's been an upshift in labor productivity, allowing the US economy to keep growing despite shedding jobs. So maybe, AI actually works.
Well, maybe we are seeing that, Keith. Yeah.
Yeah.
And the number of people unemployed for more than 27 weeks is rising sharply now. Still quite low, actually.
Yeah. Yeah, but actually, when you say it's quite low, that's a distinct rise from 2017, 18, 19.
Yeah.
Those are, those actually not insignificant. 1.5 million people.
Yeah. US labor force participation rate is actually pretty stable there, isn't it? Around about the mid 62 point something percent. So it's definitely stabilized, slightly lower than pre-COVID levels. And this is prime age labor force participation rate, which is very good and still rising quite sharply.
Yeah. So the drop in the labor force participation rate is entirely due to old people.
Yeah. And the jobs market data for June is suggesting that the market, the jobs market, is slowly slowing.
Yeah. I think all the trends, once they get going, it does appear that the labor market in the US is slowing, going lower wage growth, rising unemployment.
Yeah. And the US NFIB, which is small businesses, independent businesses, business optimism. I mean, it's slightly up on expectations, but I think it needs to sort of be spiking above that 94 level, doesn't it, to suggest there's been a significant change in trend. And small business hiring plans remain weak, as we saw in an earlier slide. It suggests that small businesses are not particularly optimistic, although they are feeling less negative about the future than they were. So contradictory data there. US used car prices still falling 0.6% in June.
I mean, that's quite a big number month on month. I mean, it's been falling quite steadily.
And year on year, they fell 8.9%. Johnson Red Book retail sales up at 6.3% this week, and they're looking pretty strong and healthy.
Yeah, surprising, given all the other data we're seeing. Red Book retail sales, perfectly, very good.
Initial jobless claims took a big drop. And last month, although we have to view this data with a pinch of salt,
last week.
Last week, although we have to view this data with a pinch of salt in terms of its accuracy, the trend is not up. And US continuing jobless claims. Difficult to know where it's going with, isn't it, Keith? 1.8 million.
It's still not huge. It's not huge.
And but over the longer term, they are climbing slowly.
Relative to previous years, still climbing, but not by much. 15% above average, not huge.
And the Dallas Fed weekly GDP estimate is 3%.
Yeah, surprising jump.
Yeah, and the Atlanta Fed is 2%. These numbers are quite noisy, aren't they? And as you said last week, they do adjust them retrospectively. And the New York Fed GDP nowcast 1.8%. And the St. Louis Fed only 0.7%.
Yeah, so the various Feds estimates are all over the place. But, Dallas Fed rising, St. Louis Fed falling, and huge difference between the two. So there you go. Economics in action, Richard.
Yeah, exactly. So the US Economic Surprise Index is actually quite negative. And indeed, job postings, this is flattening out a bit, isn't it?
It is. I do wonder whether there is some seasonality. The job postings, they do seem to flatten off a bit in the second half.
Yeah, it's true. Wage growth, job posting wage growth. Again, that's flattened off. The decline has flattened off.
Yeah, and that is perfectly compatible with 2% inflation target, frankly.
Yeah.
Wage growth in the US is much, much better than the UK or Europe. And that is fundamental to inflation coming under control.
Yeah. US Trueflation down to 1.8% and continuing to fall quite sharply over the last few weeks.
Yep. So we've stopped reporting UK Trueflation because of all the revisions.
Yeah. And the US budget deficit, we believe, is out of control. Some of the projections are ridiculous because obviously they'll never get to that point because the system would implode. But we do appear to have it's not quite exponential, is it? But it's certainly a sharp deterioration.
Well, the other way to look at the performance of the US economy, Richard, is that inflation is coming rapidly under control. Month on month, there's very little of it. And that is with a huge deficit. So they're failing to get excess demand despite running a huge deficit.
Yeah.
So if and when they actually start behaving fiscally sensible, the US economy is likely to slow. So this, to me, it looks like, the US does not have an inflation issue at all.
So part of the debt is being spent on investment in manufacturing and construction, as we've reported before, and that shows the manufacturing expenditure is 206% higher than it was in the sort of in the mid-teens, and a lot of that is funded by the government deficit.
Yeah. Now it's easy to spend that money. It's going to be less easy to earn an economic return on it.
Yeah.
So let's see. I suspect once all this surge is out of the way, that it will go back to at least where it was, if not below.
Yeah. Well, it will have to, won't it? Because well, it won't have to. They can try and continue to maintain it and borrow more. So there we have the summary, and the US may be achieving a soft landing, although some of the employment figures are sort of gently.
Yeah. Well, can they continue, subsidizing construction to this extent? Yeah. It's because that's the thing. Construction jobs have not been falling.
No. Also, the increase, a lot of the increase in jobs is in government employees.
Yeah.
So it depends really what they do with the deficit, and also what they can do with the deficit in terms of if they reach some sort of funding limit where the markets turn around and say, no, thank you.
Yeah.
But they clearly haven't done that yet.
Okay, thank you, Richard. On to China. So very little data this week. China is in deflation month on month. In June, second month in a row, prices net fell. Worse than expected. China definitely does not have an excess of demand. Year-on-year inflation 0.2%. Factory gate inflation in China minus 0.8% in June. Deflation is heading back towards zero, but not great. Exports, though, going great guns, 8.6% year-on-year, above expectations, up on May. But imports down 2.3%, way worse than expected, way down on May. So it really does look like the Chinese economy domestically is not doing great. Very difficult to tell because of the manipulation of the statistics. But if there was strong domestic demand, you would not be getting deflation.
Yeah.
And thank you to Wayne J for sending us this. So last week, Shaanxi Bank was taken over, and each week around 40 smaller institutions in China are going bust and being absorbed by larger banks. This is an ongoing financial crisis due to loans to the property sector. Now, apparently there are 3,800 troubled small banks and institutions in China with 55 trillion yuan in assets. That's about 13% of the total. And some of these banks, the worst ones, have revealed that 40% of their loans are non-performing. So normally, when you get a property crisis, you get a financial crisis because of all the bad loans to the property sector. Now, in China, that has not happened yet. But there's an ongoing, it's just ticking away in the background. And because there is deflation in China and very low inflation, bond yields have been falling sharply. And this week, the Chinese government intervened to try and force bond yields back up. Look at this. This is amazing. So, we forget just the speed with which China has industrialized after the Chinese Communist Party basically embraced capitalism, although they say they haven't. But, since the 80s and 90s, massive increases in energy consumption and GDP. So China's summary, China's economy does appear to be domestically weak and relying on strong export growth to prop up the economy. But, it's very difficult to tell. One chart. So now, a couple of weeks ago, we did a special on migration. And one of the key takeaways from that piece was that migration is ultimately demand-led. So migrants come because they know there are jobs. And you find illegal migration follows the business cycle. So this is a chart of border apprehensions in the US at the Mexican border. And you can see it's been falling. So I take that to mean that illegal migrants are being put off by a falling job availability in the US. And that adds to the evidence we showed earlier that the jobs market in the US was weakening. And errors and corrections, although this isn't really an error. So last week we talked about Eli Lilly and we showed this chart. So the blue line is the market cap, which has risen by 1,120% over the last decade. But its income and its revenues are only up 70% over that same period. So we were commenting on how the share price has run well ahead of revenue growth. But as Simon W. points out, what matters is not the historic revenue growth, but what the future revenue growth will be. And if you remember when we did the piece on Simon's investment strategy, it is very much concentrated on the future and not the past. And he has shifted backwards the blue line, which is Eli Lilly's revenue growth, and the forecast is 17% per annum over the next decade. And the red arrow is what would happen to revenues if the market is correct. But his fundamental point is share prices discount the future, not the past. So looking at the historic revenue growth is not really very informative at all. What you want to know is whether the market expectations for future growth are too optimistic or too pessimistic. And I absolutely take that point. What I would say is that so far, the expected revenue, there has been no uptick or very little uptick in its revenue growth. Will it now start to grow at 17% per annum? Question mark. And now on to silver. Richard.
Thank you, Keith. So silver, as I'm sure you all know, is a big component of photovoltaic cells. And so PV solar installations have been growing exponentially over the past few years, have been much higher than forecast. As you can see, the yellow lines show the forecast rates at any given point, and effectively what the forecast has been saying, it's going to flatten out from here, and it hasn't flattened out. So 2022 silver consumption from photovoltaics was 140 million ounces. So was it annual production of silver is about 1.1 billion ounces. So something like 9% probably of 10. Yeah, gosh, can't do my sums here. Something like 15%, I suppose, of annual production was silver, was for photovoltaics in 2022.
Yeah, that's 4 tons. 4 tons is a lot.
Isn't it? Yeah. This is a chart that shows the structural balance in the silver market and a significant undersupply in the last 3 years. So a significant deficit But the silver price hasn't really reflected that.
Yeah.
Although this chart is slightly out of date, obviously, because silver is currently at $31 an ounce. But demand is being risen by the people are now saying that actually silver is not a monetary metal, but it's an industrial metal. And its demand is driven by electronics and photovoltaics, obviously jewelry, and there's obviously some other industrial use. And apparently, each cruise missile uses something like contains something like 25 or 50 kilograms of silver.
What?
Yeah, batteries and circuitry and so forth.
Wow.
And of course, every time one of those is blown up, that's
yeah. Yeah.
Anyway, so it's quite a big industrial, quite a big defense demand for it as well. So the net of all this is that the industrial sector is creating substantial demand for silver.
It is. I mean, when you look at just the grey bars, that is very strong growth over the past decade.
And it is, industrial demand is continuing to trend higher. And so you can see that's gone from 450,000 ounces to 700,000 ounces in 10 years. But I don't think that silver production has actually increased at all in that period.
Yeah.
And here we have mine production, which is actually, this is around about 900 million ounces. It's forecast to fall by 0.8% in 2024, and it may rise in 2025 and thereafter as new mines come into production. Also, the price has gone up quite significantly recently, so that should help production growth about 4.1% in the current year, but medium-term growth is going to be limited. So there's a little bit. I think basically the issue is that mine permitting takes such a long period of time that even if silver demand rises, it takes a long time to bring new mines on. And quite a lot of silver is produced. Is it a byproduct of zinc and copper mining, I believe?
Yeah, and gold.
Yeah, and gold. So this is all contributing to an ongoing structural deficit. And this is a table of silver supply and demand, which you sort of really need to look at. But if you just take 2024 forecast, supply 1 billion ounces, demand 1.2 billion ounces. So once you take out ETPs, you get a market balance of negative 265,000 million ounces, which is actually 25% of global production, annual production, which is big.
And if you look at mine production, that is not a happy trend.
No.
That's, well down on its peaks in 2015.
This shows the London Metal Exchange Vault inventories. So basically inventories are falling quite significantly and are continuing to fall. And they are at, they are 15 months. Well, inventories are at 15 months of global supply, which is quite a lot, but at 265 million ounce deficit this year, you would expect those inventories to continue to drop quite quickly over the next couple of years.
Yeah.
And this is show the all-in sustaining cost of mining silver has gone up significantly. A lot of that is going to be energy costs, and there's also going to be, I'm guessing, permitting costs, which are very significant.
But also labour costs, 20% rise in labour costs.
Yeah. And 15% of mines are still losing money. You thought they'd shutter them until the price went up. Which is quite interesting, isn't it?
Yeah, not great.
So how do you, if there's a coming silver boom, and the structural deficit suggests that the silver price is going to have to go up to encourage production and to encourage substitution, and probably to encourage release of stocks held for investment purposes, other purposes. So how do you play the coming silver boom, which is likely to occur as a result of the structural deficit? So if you want to go into physical metals, these are some ETFs that you could go into. Story of silver is heavy, and sort of substantial investment requires a substantial weight of silver, and you don't really want to be trying to stick that in a bank safety deposit box. So I think a physical ETF, as long as they really do have the physical silver, is a good way of investing in it.
Well, good questions, Richard.
And okay, so this shows that the performance of those two, Wisdom Tree and the iShares physical metal exchange traded funds, have almost identical performance, which you sort of would expect. I know there's a fee difference.
Yeah. Well, it's good news. They do actually track the silver price, and the in which case, why don't you just choose the cheaper one?
Yeah. So we have the SILV, which is a global silver miners ETF, and that is consists of larger silver miners. And then we have the SILJ, which is junior silver miners ETF, which actually does hold some large silver miners shares as well. And but that would be more speculative because of the junior nature of some of its holding, which are more volatile. So a couple of options for you there if you don't feel like doing a lot of research into picking individual silver miners.
Yeah, the thing is about UK people who are limited to just holding UK stocks, the top one is the only one I could find.
Yeah. Silver mining shares and the ETF have underperformed the price of the physical metal, and if that underperformance is corrected, obviously there's quite a big kicker to be had in the price of the silver miners ETFs, and also if we're correct and the price of silver rises substantially because of the supply deficit, you would also expect at some point that the silver miners share prices would follow that as their profitability goes up with presumably with increasing price, and unless their costs go up by the same amount.
Yes, well, the costs are the big unknown variable.
Yeah, and that's always something to bear in mind. And finally, one of our Discord members, Uncalled Tom, suggests that these may be some silver miners for you to have a look at. They're not recommendations.
Yeah.
They are potentially high risk, with a potential high return, but also potential to lose quite a lot of your money. So I would say be careful.
Yeah. So he's particularly interested in the ones that are highly geared to the silver price. So also one of our Discord members has done some original work, and take a look at this. This is how various different silver miners are geared to changes in the silver price according to Jor's model. And his overall point is that none of them are terribly cheap. But if you want serious upside, then you need to be looking at Bear Creek and Trigon Metals. What both Jor-It and Mr. C. Peckham have been recommending is the European startup, which is Adriatic Metals, which has silver mines in the Balkans.
I just put in a health warning here, which is that if you don't understand the finances of these companies and the financing position they're in, you can get either diluted to death or you can lose all your money. Absolutely. So I wouldn't personally invest on the basis of these charts.
No, I completely agree. You need as ever, you need to do your own research. And as ever, the investment performance of junior miners of all kinds is normally absolutely abysmal. So only do it as a speculation, and preferably don't do it at all. The sensible way to play this would be to buy a well-diversified ETF.
Yes, precisely, which is my strategy.
Yeah.
So there we have Endeavour Silver. So it's had a bit of an uptick in this year because of the rise in silver prices. I expect.
Yeah. So highly geared to the silver price, actually.
Yeah.
That's very good.
First Majestic has risen 10.5%. Is that year to date? Yeah.
Yeah.
Fortuna Mining up 57% year to date.
Big numbers.
And core mining up 123% year to date. Silver core up 25% year to date.
Yeah, it's got mines in China though.
Yeah, that makes
Are
it.
they there? We ask ourselves.
Yes. Pan American silver up 45%. Since in the course of last year, it's up 1.7%, but up substantially from its March low. And Fresnillo, however you like to pronounce it, guess depends whether you're Spanish or not, is down 2.7% in the last year. It's been a bit of a dog, actually, has this company.
Yeah, UK listed. You know, your UK listed silver miners, you know, not great.
No. Hochschild up 165%.
Very good. I used to own Hochschild. I sold it.
It's a problem, isn't it?
Oh dear.
You sold it to buy gilts, Keith, did you?
Yeah, I did. Yeah.
Asiatic metals, which I think was one that Keith mentioned a little bit earlier, 12%.
Yeah.
Mines in Bosnia, that's a paragon of geopolitical stability.
Before we move on, Richard, I mean, I think this looks really good. I think silver, you know, fundamentally, as long as solar keeps rising, and yes, I mean, I think that it's the cheapest source of electricity now. So I can see no reason why silver consumption shouldn't, due to solar, shouldn't keep rising unless you find a way of substituting for silver in solar cells. Now, given that silver has had a role in photochemistry for a very long time, is there any substitute for silver?
Not that I'm aware of, but I haven't actually done much research into it, Keith.
Because that's, as far as I can see, that is the only thing that can blow up a structural bull market in silver.
I actually don't think there is, and I think if there is, it's going to take quite a long time. You know, if one is developed, it's going to take quite a long time for it to be adopted, because you know, from laboratory workbench to mass production of photovoltaics cells is not a quick process.
Because the other thing is the cost. Sorry. The other thing is the cost of a solar panel. It only contains 20 grams of silver, so it's not that much. And actually, you've seen that the price of solar panels has been totally collapsing. So, you know, the silver price is not a determinant of solar panel price, which means that, you know, if the silver price were to double, it would not have much effect on solar panel prices. So it seems to me that, you know, there is not much incentive currently to be searching around for a silver alternative. So that looks quite good.
I think that's probably right. Also, solar panels do have a lifespan, so there's going to there will be a replacement requirement in due course as well, and they get damaged by things like hailstorms.
Yeah,
possibly not that often, but more recently, they've introduced double-sided solar panels, which use, I believe, twice as much silver.
Wow, but
they have a reflective layer at the back, I think, which then reflects any photons that miss the original interaction with the silver on the way in get reflected to interact on the way out.
Can you recycle the silver from old solar panels, though?
I suspect it's not economically viable to do so.
Yeah, I suspect the same.
May be able to, but that would be my suspicion.
Yeah.
Might be worthwhile keeping it in a dump for 20 years.
when the silver price is pentupled.
Yeah. I mean, the other point is that is missing from a lot of people's perspective on silver is that if the price of gold goes up substantially, which my view is that it's going to, then silver will, one, it'll be pulled up by the price of gold, and two, it will start to take on the monetary metal mantle that it has slightly lost over the last couple of decades. Yeah. And that will create a big increase in demand for which there is no supply. So that's a potential upside for it.
Okay, well, I like this. I'm going to do some.
Good.
So, yeah, I'm going to buy the ETF in the US and, hold it for years because
I
this
think
is not a short-term thing.
this is a 5-10 year play.
Yeah. Okay, so we had a request from a viewer for me to talk about index-linked gilts. Now, as you will all be aware, I moved heavily into long-dated index-linked gilts in the expectation that falling inflation leads to falling interest rates, and index-linked gilts, long-dated index-linked gilts, which have fallen in price by one hell of a lot, would benefit. Not happened yet. I'm looking very foolish. So let's talk about index-linked gilts. And what confuses people is that index-linked gilts, there are three components to their price, and the way they're quoted on the stock market comprises only one of those components. So the price you see on the London Stock Exchange is not the price you pay. So there are three components to the price of an index-linked gilt. First is the market price, or the clean price. Now that is the price that excludes indexation and accrued interest, and that is the price you see quoted. The indexation component, all gilts are priced indexed to RPI. So when they're issued, the indexation starts at 1 and rises with RPI until 2030 and CPI thereafter. And the indexation is updated every day using a formula based on a 3-month lag to historic RPI or CPI. Some of the older gilts have an 8-month lag, but most of them have a 3-month lag. And finally, there's accrued interest. So like all government bonds, the interest is paid every 6 months, and in between the interest payments, the interest accrues. When you sell the gilt, you'll get, in addition to the market price of the gilt, you'll get accrued interest. If you buy it, you'll have to pay accrued interest. Okay, so this is from Yield Gimp, which is a great website that gives you the real yields and all the information you need on all the gilts in issue. Now, if you take T68, which I have far too much of, the clean price is 62.45. The index ratio is 1.54366. So in order to get the dirty price, you multiply the clean price by the indexation, and then you add any accrued interest, and that gives you the final price of the gilt. So although it's quoted at 62.45 in the market, this was last week, the price you will pay is 96.46. So taking that data for T68, the clean price there was 62.45, index ratio, multiply the two, add accrued interest, that gets you to the settlement price. So all index-linked gilts mature with a clean price of 100. And so the value of the gilt maturity will be 100 times the index ratio at maturity. So in order to calculate the return to maturity, you need to create an annualized return based on the capital appreciation of the price of the gilt to 100 plus expected inflation. Now, Yield Gimp will do that calculation for you And so what it's currently saying for the index-linked gilt is that you will get 3.23% in inflation plus 1.24% real. So you should get 4.47% real to maturity. So what are the advantages of indexing gilts versus conventional gilts? Well, number one is that all gilts are exempt from capital gains tax. So any capital appreciation you get on the index-linked gilt, and that includes inflation, is tax-free. So the real yield, let's say the real yield on a gilt is 4.5%, and let's ignore the coupon, which in the case of most index-linked gilts is very small. In the case of T68, it's 0.125% per annum, so 1/8 of 1%. So assuming you get all that as capital gain, you would need to earn nominal interest of 8.2% to get 4.5% return after you've paid 45% higher rate income tax. So these are very efficient ways of preserving the value of your assets against inflation. And for the first time in decades, you can get a positive real return on index-linked gilts and on gilts in general. So for the first time in a long time, you can invest and get a real return and protect your wealth against inflation. So, and compared to equities, properties, and other assets, which have capital gains tax of 20%, relative to them, they would need to earn 5.625% per annum in order to match the return of index-linked gilts. So they're very tax efficient, is the main advantage. The disadvantage is they're very risky because almost all the cash flow you're going to get from the gilts, like the T68, only pays a minimal income per annum. All the cash flow comes right at the end as a lump sum on maturity. And that means these bonds have very high duration risk. Now, previously done a beginner's guide to bonds. If you want to understand duration, please go and watch that. But what that means is small fluctuations in interest rate expectations send the price of index-linked gilts flying all over the place. Now, in my case, I've taken a lot of duration risk because I expected interest rates, long-term interest rate expectations come down as inflation came down. Now, I've been totally wrong so far. And so that risk, I was aiming to take advantage of it, and it's kind of blown up in my face. But if you think that inflation is going to come down from here and interest rates are going to come down, then taking duration risk is a good way to play that. The other downside is because the coupons are quite low, it's not a good way of getting income. If you rely on income, you ain't going to get it. But the alternative is simply to sell some index-linked gilts when you need the income, when you need money. That risk that the price in the market varies a lot means that you will only get the return you expect if you hold the bond to maturity. If you sell it prior to that, the price could be wildly different from what you expected, and you will get a wildly different return from the price from the return you expected when you bought it. And to give you an idea of just how volatile index-linked gilts are, this is T68, which is the subject of my disastrous speculation. Now, you will see that it peaked in January 2022 at 325. And I thought that it was bottoming here and it would go up to what, 125, 150, all of which was tax-free. Instead, it's collapsed and it's currently at 62. So I have lost a great deal of money. That is the downside of holding index-linked gilts now. But the plus side is you can now earn a positive return on your capital if you hold those for the long term. And I continue to believe that interest rates will come down, inflation will come down, and not everyone in the economy can earn a positive return on their assets because we've got an aging population and too much savings, and everyone has done very well over the last decade. And I continue to think that the challenge going forward will be preserving that wealth, because there's a great deal of inequality between people with assets and people, the young people who don't have assets, and any sort of rebalancing will involve negative real returns to people who have assets. So not looking very clever at all at the moment, but going forward, I think that has to be the case. And interest rates ultimately are a function of productivity. And if you have a low productivity economy like the UK, then it can't sustain higher interest rates because the new businesses are not productive enough to generate the excess profits to pay the higher interest rates. So medium term, I think interest rates have to come down, but right now, not looking very clever. So that's it. Brief overview of index-linked gilts. If you are interested further, please go and have a look at our beginner's guide to bonds.
So we're going to have a little look now at US housing affordability. Thank you for the index-linked gilt section, Keith. It was very interesting. So this is a chart we showed last week of how much cheaper it is to rent than it is to buy. This is so it's 50% cheaper to rent than it is to buy a home on purely sort of monetary level in the US at the moment. And that's because mortgage rates are high and house prices are high. So house prices are the least affordable that they've been since the 1980s. And rents haven't kept up with those price levels. Here's a little bit of mathematics. So if you rent a flat for £1.1 million, if you rent a $1.1 million flat, it costs approximately $2,400, the sort of average figure for that rental. But buying it, if you work through the sum below, would cost you $8,000 a month. Admittedly, at the end of that period of purchase, you would then own the property. But in terms of a sort of current cash flow, there's a huge difference between renting and buying. So this is a second example which shows that if Leandra buys a house that costs $500,000 with a $100,000 deposit and a 5.65% fixed interest rate, and moves at the average period that US homeowners move out, which is 13 years, and they cannot then take their mortgage with them. Basically, her payments resolve as she will have paid $260,000 of interest and will have £98,000 of capital repayment. So she will have paid $360,000 in total, out of which she will have received only £97,000 of value. And that doesn't feel like a good deal, does it?
No. And so the alternative would be she rents and saves money, and she would have saved more than $97,000.
And then she can, yes, precisely. In fact, she could afford all of this. In the first instance, she could probably save the cost of buying this property, assuming prices remain constant. Anyway, what it shows is that the US housing market is grossly distorted, really, and the differential between renting and buying seems absurdly large.
Yeah. So why are house prices rising? And it just mystifies me.
Yeah, I get it completely. And this is showing that US new homes are not selling. So this is months of supply. So since 2021, the months of supply of new homes has gone from 3.5 to 9.5. And
Yeah.
in that same period of time, existing homes has gone from 2 to a little bit below 4. So in absolute terms, a huge difference. And in relative terms, one has nearly doubled and the other one has nearly tripled.
So what's going on in the US? House prices are rising, but houses are not selling. New homes are not selling.
So what's the incentive to build when you know you can't sell?
Well, if you can sell it, your margins are fantastic, but they're not selling. So the US housing market remains a mystery.
Yeah. And this is showing that new apartments are filling up at the slowest pace since 2020. So demand for new apartments rose very dramatically in the early 2020s and has fallen equally sharply since mid-2021, and is lower than the pre-COVID. Pre-COVID, it was sort of slowly declining, wasn't it? But it's that, if you sort of extrapolate that pre-COVID trend, it's now below that trend line. And lots of new apartments, which we discussed a few months ago, Keith, probably about a year ago, didn't we? The multi-occupancy buildings that were being created. So these are now hitting the market, and a lot of new apartments hitting the market, and the demand for renting them is dropping. And this is a national vacancy index, which has risen substantially from 4 to 7.7% since early 2022. 6.7%, beg your pardon. So there's a generally rising apartment vacancy rate.
Yeah, so which suggests that rental prices have further to fall, and 6.7% is actually quite a big number. More than 1 in 20.
Yeah, given the supply of new apartments and the general state of the rental market, it does look like a lot of these properties are going to be built into emptiness. And this is a US monthly rent year-on-year change, which actually is a negative level at the moment. And that means that the differential between renting and buying is increasing.
Yeah.
So this is a rhetorical question.
Yeah.
Why are house prices still rising?
So in summary, I just don't understand the US housing market. We've talked about this loads of times, but house prices are rising. Admittedly, a lot of that is caused by the largest houses as opposed to the median or smaller houses. But house builders are still pumping out loads of single family houses, but they're not selling very well. So something's got to give, surely.
Surely, yeah. And we've been seeing this for a long time.
We have, and we've been wrong.
But it hasn't given.
Yeah. And on to inflation watch, Richard.
Thanks, Keith. So only US figures out recently. We got 3.1% CPI in June, which was down, and 3.3% core CPI in June, which was also down. The FOMC meets at the end of this month. Bank of England meets on the 1st of August, and the ECB meets next week. I'd be surprised if the Fed reduces interest rates. I think we're getting a bit too close to the US presidential election for that, and they're very cautious at the moment. Bank of England, I suspect, will keep rates on hold, and the ECB, I think, is on the cusp of reducing rates.
Well, the ECB's already cut once. I don't think they're going to cut again. No. I don't think they're going to cut again until wage inflation comes down, convincingly comes down. Now, the problem with the ECB and the Eurozone economy is France. We just don't know what's going to happen there. So watch this space.
So the New York Fed Supply Chain Index this is a price index, is still remaining below zero, despite the issues that we've got in the Straits of Hormuz and cargo be redirected around Cape Horn, Cape of Good Hope, etc. New cars. Is this suggesting that new car prices are going to drop? Certainly.
Well, yeah. There's been this huge one-off surge, and you'd think that they now stabilize again.
Yeah. Certainly electric vehicles aren't being purchased because they are reputedly too expensive.
Yeah.
US loan growth is small and large bank lending growth is continuing to slow rapidly, and that's a bad sign for economic growth.
Yeah, well, this is another thing I've got totally wrong, Richard, because I was expecting that a negative credit impulse would lead to slowing US economy. The US economy has been amazingly resilient.
Yeah. A lot of government debt, though. And as energy prices have caused or helped deflation, energy prices have stopped falling and are possibly starting to rise now. Is inflation beginning to be pushed up by rising energy prices? I mean, energy prices are a big component, clearly, of inflation, CPI. So are we going to now start to see some energy price driven inflation?
Yeah.
So inflation is returning to target, but it does historically come in waves, and each wave is smaller than the preceding wave. My question would be, as we get nearer and nearer to target, are we actually going to be more and more inclined to have a second subsidiary wave of inflation?
I personally can't see that, Richard, but I think there are big lags. Basically, inflation is taking much longer to come down than I had anticipated because, I mean, certainly in the UK, wage growth remains very high.
Yeah, indeed. I mean, obviously, we shall have to see. But if you look at UK wage growth, that is inflationary in nature currently.
Yes, of course. Yeah. So, the chart we showed you earlier about aggregate wages leading GDP growth is true for all economies. So, in the UK, where we're still having wage growth of 6%, then nominal GDP growth will remain high and inflation will remain high.
Yeah.
And on to recession watch. So this is the US unemployment rate. And, all the data we've shown you on the US jobs market shows that the US jobs market has weakened in a way that is consistent with recession, but we're nowhere near a recession. Odd. The way the labor market is weakening in the US is consistent with previous recessions. Just saying. The SARM rule is rising, but as we talked about earlier, it could well give a false signal this time because much of that rise in unemployment is due to new entrants to the job market. Bankruptcy filings are rising.
They are, but they're not. They're not out of.
I completely agree.
Sync, are they? They need to.
Yeah, they're not terrible.
Yeah.
But another way to look at it, Richard, bankruptcy rising are their highs of the pandemic. Well, of course, the governments intervened to keep as many companies going as they could then.
Yeah.
Now, we've talked about construction and how, US construction market's mystifying, but last month did see a jump in the challenger job cuts in construction. Too early to tell whether that's something more, but, noticeable jump. Trucking employment, another recession indicator that has failed. The crisis in commercial real estate remains very real. So, summary, there's plenty of reason to think the US economy is slowing.
Thank you for that, Keith. So, soft landing watch. US bankruptcy filings are possibly rising slightly, but they're certainly not. They're not significantly elevated yet.
Yeah. So they're rising, but
Yeah, and US real personal incomes continuing to rise, fairly steady trend really since mid 1980s. So US airline travel continues to grow to new highs. Is this number of journeys?
I assume it is, yeah.
And JP Morgan thinks the US economy is doing just fine, although it weakened slightly. So, and
Yeah,
they're
actually,
not wrong, are they?
yeah. Well, sorry, this is global, so this is not US. This is global. They think the US world economy is doing just fine.
Mm. Yeah, the US economy seems to be doing fine, and there are some little hints that things may not be quite as good under the covers, but we've been saying that for a long time, haven't we, Keith? And we've been wrong.
Been totally wrong. Yeah. And on to other charts. So this is a chart of tech jobs growth in California. And you'll see that actually net, it's been declining and it is now at 0. So although we've had a huge tech boom, it's in hardware, not software. Pause, take a look, but you're seeing you're seeing falls in tech jobs in computer systems design, web search, etc. And there's a lot of investment going into manufacturing. In fact, there's been an investment boom everywhere because of the low interest rates during the pandemic. So companies locked in cheap funding, they're now spending it. But in the case of manufacturing in US, China, ultimately, you're going to be producing more goods and they have to earn a return on that. It's easy to spend the money. So let's see, that could be disinflationary, hopefully. And we showed you this chart, last year, but just a reminder of how extraordinary house prices are. This is house prices in Amsterdam going back to 1620. Absolutely phenomenal, the rise in house prices compared to rents. So this is a financial bubble. Essentially, the fall in interest rates put a firework, a rocket underneath house prices, and they have not come back to earth yet. But financially, it doesn't make sense, as we showed you for the section on the economics of renting in the US.
I think we have to point the fingers at the central banks for this and say that they have created huge societal disruption with their policy of ultra low interest rates and QE, which are going to take decades to work through. And their degree of incompetence, in my mind, is extraordinary. And they're operating in a world of a little bubble of groupthink. And it's funny how human beings never learn the lessons of groupthink.
Yeah. 65% of people think it was now wrong to leave the EU. And actually 71% think that leaving the EU was bad for the UK economy. Will Keir Starmer negotiate a better trade deal with the EU? I really hope so.
I really hope so too. And I'm sure he will, actually, because he'll be much more emollient and, frankly, much more sensible with them than the Conservative government was capable of being.
Yes. I thought this was amusing. This is an example of, econometrics in action.
No, actually, Keith, this is when central banks started to reduce interest rates.
Yes, exactly. And on to good news. Now, one of our viewers, Michael, sent us this. So hopefully this is an example of how demand pressures in the UK economy are leading to service providers cutting the price of their offerings. So this is a pub in Whitton, which has cut the price of a pint to £1.95, and you can get 4 pints plus all you can eat in crisps in lunch. That's a lunch deal, 90 minutes for 20 quid. All part of a healthy northern diet. But, you know, that's an amazing deal. Head up to the Whitton Chimes in Northwich. Sorry. So the pub is in Northwich in Cheshire, I believe. And second piece of good news. So this is the UN, and we've been talking about demographics in the preceding weeks. And this week they came out with revised demographic estimate for the world population by 2100, and they've revised it down by 200 million. So they now think that the global population will peak at 10.3 billion, up from current 8.2 billion. Frankly, it seems like yesterday that we had 7 billion. But that still means there will be 25% more people by the end of the century.
Can the planet cope?
Yeah. And on to equities. So the world bull market continued last week, up 1.1%, up 13% year to date. The all share continues to lag, up to 0.2%, up 6.5% year to date. Euro stocks up 0.4%, up 8.6% year to date, despite the Eurozone economy not doing well and interest rates being very high, the highest they've been in the Eurozone. S&P 500 continues to climb. It had a bad day yesterday, but still ended up 0.9% on the week, up 17% year to date. NASDAQ, amazing, despite falling sharply last night, down up 22% on the year. The Russell 2000, the inflation numbers sent it up over 3% yesterday. It's now up 4.3% year to date. Sorry, is now up 4.8% year to date. Hang Seng also joined in, up 4.5%, up 7.2% year to date. Topics up 0.4% on the week, up 22% year to date. Bitcoin had a bounce, up 35% year to date. Sterling, the weak inflation numbers in the US combined with the strong GDP numbers in the UK sent sterling up 1% on the week, and it's up 1.3% year to date. Eurozone, the euro rose 0.4% on the week, is down 1.8% year to date. Dollar index fell because of the weak inflation print, up 3.2% year to date. VIX remains astonishingly low, although it did climb a bit yesterday. Charts relating to equity markets. Well, volatility is extraordinarily low, but tends to rise over the summer months. So be warned. And that is particularly true in election years. The US election could be uniquely divisive, with lots of implications for the outlook of fiscal deficit and in interest rates. So be prepared. And credit spreads are very low, in part because volatility is very low. If volatility rises, so will credit spreads. However, NASDAQ seasonality is very supportive. NASDAQ tends to rise strongly in the second half of the year, and it's had a great first half of the year. Who knows? Earnings expectations continue to rise despite a deteriorating economy. The median stock is down on the year, unbelievably. So the market is being driven higher by the big companies. And the last time breadth was this bad was the depths of the GFC, when Lehman went bust. And the market seems disconnected from the underlying economy, as measured by how much goods are moving around the US economy, by the truck tonnage index. Not much going on. Equities off to the races. Valuations are stretched compared to history. And that's because long-term earnings expectations are stretched. So investors are really buying into a rise in corporate earnings due to AI. When we compare the price of Nvidia and Cisco during the dot-com, Nvidia's share price has absolutely exploded. But this time is different. Nvidia has amazing earnings. And the reason Nvidia's share price has shot through the roof is that its earnings expectations have shot through the roof. So compared to 12 months ago, analysts and investors are convinced that Nvidia can keep on growing its revenues very strongly in the next 5 years. And investors are buying into that. So the 3 times leveraged Nvidia ETP listed in London has become the most actively traded instrument on the London Stock Exchange. Lots of speculation around the world fueled by Nvidia. Now, Sequoia Capital did an analysis of the revenues that tech companies who are buying Nvidia chips need to earn to justify their investments in AI. And it thinks there's a 500 billion hole. So it's saying in order to justify their annual expenditure on AI of 150 billion, so 300 billion, they need to earn revenues of about 600 billion. But Sequoia think they can only earn around 100 billion. So they're saying there's a 500 billion of revenues missing. Bottom line, they think tech companies are overinvesting in AI compared to potential revenue growth. Now, that's not necessarily bad for Nvidia, but it's bad for the tech companies. And when you look at Apple, I mean, this is indicative of what's going on. I mean, its price to sales has gone through the roof. It's up 3 times since January 19, pre-pandemic. So valuations have risen much more. So the rise in Apple's share price is entirely due to increased valuation, not increased sales. And what's driving the stock market is investors are buying. So the highest households have the highest allocation to stocks in pretty much 70 years, and asset managers are all in. The US economy, we have shown you data which says that it is certainly slowed since the start of the year and the labor market is slowing, but analysts are forecasting that earnings for the S&P 500 will rise by 20% between now and the end of 2025. It's difficult to see how that's going to be achieved unless you get a strong cyclical upturn in the US economy, of which there is no evidence currently. On to commodities. So, quick summary: energy generally weak. Industrial metals actually surprisingly weak given the falls in interest rate expectations. Precious metals, gold and silver up, platinum group metals down. So energy, Brent had an indifferent week, down 1.4%, up 11% on the year. WTI, very similar. Numbers specific to the oil market, well, there was another build last week. So having had a huge draw the previous week, back to builds. US oil market oversupplied last week, and US total oil production hit a high for the year, which is equal to its production at the start of the year. So the have previously been forecasting the US will return to growth in the second half of the year. Is that a sign that that's starting to happen? No change in the Baker Hughes rig count, which is still down 21 on the year. This is UK oil output and suffering from a chronic lack of investment, as we've put in the UK windfall tax at 75%. This is not at all surprising. Now, Saudi oil exports actually fell to their pandemic era lows recently as it ceded export markets to Russia, market share to Russia. Saudi is propping up the market. Now, last week we were talking about how Saudi Arabia is shifting to renewables. And if it does that, then it can cut the amount of oil it burns for electricity generation. And the bottom line is that would free up around 500,000 barrels a day of oil, which it could export if it hits its renewable energy targets. But so far, there is no indication it's serious about renewables, and the likelihood of it hitting its renewable target is frankly very low. Currently, it burns around 1 million barrels of crude a day for electricity. So cutting that by half would free up about 500,000 barrels a day for export. Hedge funds are bearish gasoline. So do they think the US economy is slowing? On to natural gas. In the EU, natural gas futures fell 6% on the week, down 3.4% on the year. And that's because Norway, resumed exports after some maintenance. In the UK, also had big falls in natural gas prices. Great news for inflation. US natural gas prices also coming down. Coal drifting off, down 8% on the year. Uranium going nowhere, down 5% on the year. And onto industrial metals, which was surprisingly weak given the falls in interest rates. So aluminium down 2.4% on the week. Cobalt going nowhere. Copper down 2.2% on the week. Is that little mini bounce fading again? Chromium unchanged. Iron ore off on the week, down 23% on the year. Lithium down 1.1%, down 6.2% on the year. Neodymium unchanged, down 18% on the year and going absolutely nowhere. Reminder, neodymium is used in electric motors and in big components in EVs and also in wind turbines. Nickel fading, as you'd expect, given that there's due to be a huge surplus of nickel coming from Indonesia. Tin doing very well, up 34% on the year. Zinc fading, but still up 10% on the year. On to precious metals. Well, gold had a strong rise, up 1.7% on the week as we got the soft US inflation numbers. Silver kind of followed a bit, up 0.7%, up 27% year to date. Platinum down on the week, going nowhere on the year. Rhodium fading again, going nowhere. Palladium dropping sharply after its recent bounce, down 20% on the year. Finally, onto rates. So the latest yield curve is in black, and markets, not much change over the last week. What's really caught me out is this big rise in the tail. So markets worried about the long-term outlook for inflation and charging a rising term premium. We know that up to the 10-year, the term premium is negative, but that rise in yields from the 10 to the 30 has to mean that the term premium rises quite sharply thereafter, unless markets are expecting interest rates to be systematically higher after 10 years, which seems unlikely. Similar thing happening in the US, but much less of a rise in inflation expectations and the yield from 10-year onwards. So what's odd about the UK is that rise from 10-year plus. Markets are more confident in the US having inflation under control long term than the UK. Now, if you look at the US 2-year, so medium term outlooks for the interest rates, the 2-year yield has bounced a long way above its long-term trend. Will it go back to trend medium term? I think yes, but I've been wrong so far. And bonds are deeply out of favor. You are looking at the light blue line as a percentage of our assets under management. It has been steadily falling. Okay, so this is this week. We have the UK 2-year. Actually, there's a bit of a bounce this morning after I did this chart, but back towards its lows. What's frustrating for me is the 10-year. This is as of last night, good day yesterday, but it's bounced again today, which is annoying and terrible for me. And there was the 2-year is its lows for the year, the 10-year is not. So what's happened this year is medium-term interest rate expectations have risen, and this is the 30, very frustrating. Nowhere near its lows for the year. And if we look at the 30-year over the maximum period that trading economics provides, you'll see that it's come down from 16%, hit lows of just over 1%, is now at 4.6%. I think that it'll come back somewhere to the 3 to 3.5% range. We added one hell of a lot of debt in this period, and as that comes to be refinanced on higher rates, that will be a drag on the economy. I do not think that these rates are sustainable. US 10-year coming down. That looks like that's on a downward path. The German Bund yield come down on the week. French also down. Italian, that looks like a sharp breakdown. Good news. And Greek. So concluding comments. Well, inflation in the US is falling. And that seems to be a sustainable fall. So interest rate cuts in the US are coming into view. The market expects that to happen in September. We had non-farm payrolls out last Friday, and they showed a US labor market that is continuing to weaken. Now, generally, those are medium to long-term trends. Drops in employment continue, and the trend in employment is down. But the US economy continues to grow. We are in the soft landing. Will the Fed manage to lower interest rates and keep the economy growing? Now, Richard has had to go, I'm afraid, so it's just me reporting this week, and I had a better week, but I'm afraid to say I'm having a terrible morning. So the UK gilts gained strongly yesterday as the US inflation numbers came in soft, but we are not seeing a sustained fall in interest rates in the UK. The market needs to see that UK wage inflation is coming down, and UK interest rates can therefore come down when there's a sustainable fall in UK inflation. UK inflation has returned to the 2% target, but markets are worried that high wage inflation means that service inflation will stay strong and the current low inflation will rise again. So very frustrating to me. For me, I'm having a terrible year. Good luck to everyone else. Congratulations. I'm sure you're all doing better than me. But so I'm kind of stuck in this trade, frankly, which has been a total disaster. Medium term, though, I don't think that these high interest rates are sustainable as inflation returns to target. So I'm sticking with it. It hasn't been good, very stressful. And today is a terrible day, as I was really expecting the good US inflation numbers to spark a sustained rally in US bonds and UK bonds, but that has not happened. Markets are not convinced that the UK has got inflation under control. The good news for the UK is that we may have the most stable government in the developed world over the course of the next 5 years, so that should be good for gilt. But not seeing at the moment, I'm having a terrible year, and that minus 8.5% return year to date for me will include around 2% of nominal return on the gilt. So it's really, really bad. So very frustrating. I've put this trade on for good reasons, I thought, but it's been totally wrong. If I had simply followed the market as Simon W does, then I would be doing vastly better. But we each have our own strategies. This is mine. And for the first time in a long time, I've been totally caught out. But investing is a long game. And I've just got to stick with it and expect that inflation will continue to come down. It's come down a long way. I can see no reason why we'll have a second wave of inflation in the UK. Interest rates are at their highs. 3 million households in the UK have yet to refinance onto higher rates. As that happens, the UK economy will continue to be slowed by higher rates. So very frustrating for me, but I'm now going to go on holiday and do my best to forget about my disastrous portfolio. I hope you're all doing better. Reminder, no PM next week because I will be in the Lofoten Islands in Norway trying to forget about things. So hope you have a good couple of weeks and I'll see you then. Thank you for watching. Please can you press subscribe, and it's goodbye from me, Keith Jordan, and goodbye from Richard Wheater. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.